Hello, welcome back to our lecture for the second week, where we'll be discussing further into the books of original entry as well as the books of double entry. Okay, uh, like I said, we need to have a solid grounding when it comes to the use of these books. Okay, because in a typical exam, the examiners might ask us anything around the area of these accounting records. Okay, so we need to be very vigilant. Okay, but like I also have pointed out that no need to fear. All right, so without wasting time, let us go to the next example. The journal. The journal, like I said, is an account record, okay, which is also part of the books of prime entry, but usually records very rare accounting transactions, or it also records the adjustments of errors, as well as some transactions which do not frequently occur. For example, the payment of rent, uh, yeah, the the recording of the rent expense itself usually require the journal. Okay, but you must also be aware that when we talk of journal entries, these are, the we are referring to the double entry. Okay, it's another way of requiring students to come up with the double entry for a particular accounting transaction. Okay, so if the examiner says show the transactions by way of journals, or come up with the journal entries, we are simply saying that can you come up with the double entry for that particular transaction? Are we together? So I want clever students who are quick in identifying, in articulating information, okay, in articulating business information. So um, before we go further again, I want you to understand this before we crack crack down this example. Okay, there is what is called the Peels acronym. Okay, many people have come up with um, the definitions of, I mean, my writing is very bad, so Peels. Okay, the Peels acronym. To me, I call the P purchases. Okay, E, expenses. A, assets. Then ARA is for revenue. Okay, I know I call it revenue, but sometimes retained earnings, or the profit retained. Okay, retained earnings. You understand this term as you progress with your studies. Okay, let me just say profit retained in the business, retained in the business, okay, are revenue or retained earnings, okay. But normally, when we talk of revenue, we are also talking of sales, okay, the sales, so forth. Then L stands for liabilities. Liabilities, which are obligations the businesses to settle, okay, when it purchased the goods on credit or when it did not pay for its expenses, their liabilities, it has to settle them up. Then S, to me, some say is sales, but to me, I like to put it as share capital. Share capital, share premium, etc. And here for R, I also talk of reserves. You understand these terms as we progress with our accounting studies, but for the purpose of learning, I want you to just scan this, have it cast in stone, okay, cast in stone, so that it won't be stolen from you. You just have to cast it at the bottom of your heart until you finish your ACCA course. If you have this acronym in your mind, you're going to be home and dry. You're going to pass everything. All right. So what happens here is, I have said that on this is the demarcation line. Okay, demarcation. Let me just draw this demarcation in red. Let me just put it in red. Let me put it in red, and the thickness should be louder. Okay. On the left hand side, we are having the debit. On the credit, on the right hand side, we are having the credit. Okay. This is a very important lesson, and I want you guys to excel in your studies. Now, these guys where I've indicated the debit are increased by debiting. Okay, they are increased by debiting. Okay, they are increased by debiting. Okay, for example, purchases. If you buy goods on credit, or simply if we just buy goods for resale, we are debiting purchases and crediting something. If we have bought them, if we have bought the goods on credit for resale, we're going to debit purchases and credit payables. Okay, credit payables, because we are going to pay or credit that particular payable. If it is Metro Pitch, we're going to say credit Metro Pitch. It's our supplier, is our payables. So if we incur an expense, let's say rent this month, we are debiting expenses. We are increasing expenses. Okay. Similarly, assets. If we have bought a car, we are increasing cars. We are increasing assets. These are the things which we own for a long time in the business, so we call them assets. They may also not be for a long time, but they are also called assets. For example, inventories for goods for resale or goods for sale. They are current assets, so we own them. They are our assets. They are also increased by debiting. Then when we go to the other side of the acronym, these these guys that also increased. They're increased by crediting. Increased by crediting. These ones, they are increased by crediting. If this year we have incurred or we've failed to pay our suppliers in time, we are increasing liabilities, so we are crediting liabilities. If we've made sales, if we are selling goods, the sales figure is credited. Profits figure is credited by default. They've got credit balances by default, and these ones, they've got debit balance by default. Are we together? So let us now do the example for the journal entries. We just want to do just 2 or 3 entries here. Okay. The following summary is a summary of the transactions of YV's hairdressing business, of which Paul Brown is the sole proprietor. Okay. On 1 January, he put in cash of $2,000 as capital. Okay. He put in cash of $2,000 as his capital, as the capital of the business. Remember the accounting conventions which say that the business should be separate from its owner. Okay, a separate entity concept. So by so doing, the transaction should be recorded separately. Okay, so what happens here? What is the journal entry, or what is the double entry? Okay, we've put cash into the business. So to the business, okay, to the business has received cash. Business has received cash, and cash is an asset. Cash is an asset. So an asset is increased by debiting. So we debit cash. We debit cash 2,000 and credit what? What are we going to credit here? We are going to credit something, because by the end of the day, the left and the right side should balance. The debit and the credit should balance. So if something okayed this side, something has to okay also this side. Okay, but sometimes they okay on both sides. They do happen. Sometimes they happen on the same side. So what is happening here? We debit cash and credit what? We're going to credit capital. Okay, capital 2,000. In this case, since it is a sole proprietor, the capital should be Paul Brown. We're going to credit in Paul Brown because he has loaned the business. Capital is a liability to the business because it's another form of a liability, but from an owner, from the business owner. The business is owing Paul Brown. Like I said, the business and the owner are different people. So the business is to respect Mr. Paul Brown by recording that as recording Mr. Paul as a shareholder, but I mean as a payable. But in this case, it's a special payable, so we call this payable capital, because Paul Brown is a very interested guy who is running the show. He's the owner. Okay, so we call that type of liability capital. Okay, that's capital. All right. So debit cash, credit capital. Paul Brown in bracket. Then on the same date, the business purchased brushes and combs for $50. How do we record this one? Brushes and combs. We are going to debit the assets, brushes, debit brushes and combs, brushes and combs, $50, and credit what? Cash, because cash is left the business. So this is why I say that sometimes it happens. Okay, it happens on the this double entry, the debit and credit. It happens between these guys here. Okay, these PLs, they will be playing one another in a debit or crediting fashion. Okay, the assets are being increased, but cash also is also an asset, but it is being reduced. So if we are reducing, if you want, remember I said we increase this side by debiting, but when we want to reduce them, we also, if we credit them, we'll be reducing. Here debiting will be reducing, but here crediting will be reducing these guys. All these guys will be reducing them by crediting. Here we'll be reducing them by debiting. Are we together? That's accounting. That's accounting, guys. I'm sorry, and that's how it is. Okay, that's how it is. So this is the thing that will be happening here. Okay, but make sure that the values for the debit and the credit, they should tally, they should equal. So we are done with that example, ladies and gentlemen. Let's move on, because we have got a lot of work to do. Okay, now there is an issue for balancing ledger accounts, and there is Mr. Rindai Banga. Okay, it's example there. When you talk of balancing accounts, we are just saying by the end of the day, the accounts should be balanced. By the end of the day, the accounts should be balanced, so that we know what is the balance brought forward to the next. I mean, what is the balance brought down to the next accounting period? That's the essence of this balancing thing. Okay, that's the essence of the balancing thing. I think we'll continue. My laptop here is having some battery issues. It's now showing signals that it can cut anytime, so we'll continue in the next video. Thank you.